All right, so 40% annualized return for like 20 years.
Yeah, that's the kind of track record that makes Joel Greenblatt a legend.
The total legend. And you, lucky listener, you gave us a ton of material on this guy. So
Thanks for
today
diving deep.
we are diving deep into Greenblatt's world.
Trying to unlock his secrets.
See if we can, what he's all about.
We've got articles, research papers, even
Notes from the listener.
yeah, notes all about Greenblatt's strategies, and there's this fascinating thread about market cycles running through it all.
Yeah, that should be really interesting to unpack. I mean,
Oh, for sure.
anyone who follows the market even a little, knows it's a total roller coaster.
Oh, yeah.
Our source material even points out, like, the S&P 500's history is just booms and busts.
Totally.
The dot-com crash, the 2008 financial crisis, like, we've seen it all.
We've seen it all, yeah. And Greenblatt sees this as, I think he said human nature in action. Greed drives markets up. The fear crashes them down.
Classic.
Yeah. It's a pattern as old as time, really.
That kind of makes me feel a little better about my own less than perfect investment decisions. Haha.
Right.
We're all human.
We are, yeah.
But Greenblatt, it seems like he's figured out how to make this whole fear and greed thing work for him.
He has, yeah. What's remarkable is that Greenblatt doesn't believe in trying to time the market.
Oh,
At all.
Okay.
His whole approach is about finding the right companies
Got it.
to invest in no matter what the market's doing at any given moment.
Okay, so if he's not, like, watching the market like a hawk, trying to predict everything,
Right.
how does he decide which stocks to buy?
Right.
What's his secret?
Well, he has two key indicators that he looks at.
Okay.
Return on invested capital, so ROIC,
Okay.
and then enterprise value to EBIT.
Enterprise value to EBIT.
EVBIT for short, yeah.
Okay, those sound kind of intimidating. I'm guessing there's more to it than, like, just Googling those acronyms.
Oh, yeah, for sure. I think the car analogy from the source material is a good starting point. Think of it this way. You're buying a used car, right?
Yeah.
You want one that's in great shape, runs well.
Right. Doesn't need constant repair.
Yeah, exactly. That's your ROIC.
Okay.
How efficiently a company uses its money to generate more money.
Got it. So a high ROIC means a company is using its resources effectively to grow.
Exactly.
Okay. What about EVBIT?
So that's about getting a good price on that used car.
Okay, so I don't want to overpay for a clunker. Yeah.
Exactly. You want to make sure you're getting a good deal.
Right.
So EVBIT helps you figure out if a company is undervalued compared to its earnings. It's like checking if that used car is actually a steal for the price.
So Greenblatt wants companies that are both high-performing
Yeah.
and a good deal.
He does, yeah.
But how did he actually, like, put this into practice?
Right.
Did he start out with a huge diversified portfolio?
Actually, no. The source material points out that he began his career taking some pretty big risks. He was managing a concentrated portfolio of just 6 to 8 small cap stocks.
Small cap.
Yeah.
Remind me what that means again?
So small cap stocks are companies with a relatively small market capitalization.
Right.
They're often younger companies
Okay.
or those in like niche industries that have, the potential for big growth,
Right.
but also come with higher risks.
Okay, so they're like those hidden gems everyone's always trying to find.
Mm-hmm.
The ones that could just explode in value.
Totally. Yeah.
But also riskier. Yeah.
Riskier, yeah. And one of the big risks with small cap stocks is low liquidity.
Oh, liquidity. Okay.
That means it can be difficult to sell your shares quickly if you need to.
Right, because not a lot of people are trading them.
Exactly, yeah. It's like trying to sell that used car in a hurry. You might not get the best price.
Makes sense.
Hmm.
And wasn't there something in the research about, like, shady financial practices being more common with some smaller companies?
Yeah, that's a valid concern.
Yeah.
Smaller companies sometimes lack the same level of regulatory scrutiny
Right.
as larger, more established firms.
So there's more opportunity for things to go wrong.
There is, yeah.
Okay, so Greenblatt started out as a bit of a high roller, betting big on these risky small cap stocks.
Yeah.
Did he always stick with that strategy?
Well, actually, that's where things get interesting.
Okay.
As Greenblatt's career progressed
Yeah.
and he was managing more money,
Uh-huh.
He actually shifted to a much larger, more diversified portfolio.
Okay.
We're talking over 400 stocks.
Wow, from just a handful to
Yeah,
over 400.
wild, right?
What drove such a drastic change?
Well, the research suggests that as he started handling larger sums,
Yeah.
he saw the need to manage risk more effectively. So, a bigger, more diverse portfolio, it helps smooth out the bumps in the road. Instead of those like wild swings in value you get with a concentrated portfolio,
Right.
things become a lot more stable.
So he went from high risk, high reward to a more balanced approach.
He did.
That's a pretty big evolution.
It is, yeah.
It is.
And this ties into another fascinating point from the source material.
Okay.
According to research, only 4% of stocks are responsible for driving all of the market gains.
Wait, seriously?
Yeah,
Only 4%?
that's it.
Wow. So picking the right stocks is even more crucial than I thought.
Hugely.
No wonder people spend so much time researching.
Oh, yeah. It really highlights how difficult it is to consistently beat the market.
Right.
And it's particularly interesting in the context of Greenblatt's more recent investment strategy.
Okay.
He's actually shifted his focus to those mega cap companies that kind of dominate their industries.
So,
Like Apple, Microsoft, Amazon, the big names everyone recognizes.
so he's gone from small cap daredevil to betting on the giants.
Kind of, yeah, in a way. But there's a nuance here that shouldn't be overlooked.
Okay.
While he's holding these, large established companies, his overall exposure to equities is still quite low,
Interesting.
which suggests a certain level of caution,
Yeah.
a recognition that the market may not always go up.
Interesting. So it's like he's acknowledging the potential of these big players,
Yeah.
but also hedging his bets. Maybe he's not entirely convinced the market is in a good place right now.
That's a very astute observation.
Yeah.
He could be concerned about overvaluation, which wouldn't be surprising given his focus on value investing.
This is getting really interesting. So we've got Greenblatt, a guy who started out making risky bets on small companies,
Yeah,
then shifted to a more diversified approach.
right.
And now seems to be navigating this kind of tricky market by betting on big, established companies, but staying cautious.
Right.
It's a fascinating journey.
It really is. And it raises some important questions about, how his approach, which has evolved so much over time, can be applied by individual investors today.
Exactly. I mean, what can we learn from all of this?
Right.
Is there something here for both, small investors just starting out
Yeah.
and those with like larger portfolios?
Absolutely. There are valuable lessons for everyone, regardless of their experience or the size of their investments.
All right, well, let's unpack those lessons. I'm ready to go deeper into Greenblatt's world and see what we can apply to our own investment strategies.
Let's do it. So you're interested in applying Greenblatt's lessons,
Yeah.
especially for investors of different sizes.
Yeah, exactly. Like, how does this apply to, me and the listener versus someone managing millions or billions?
Right. Right.
Does his approach scale?
Yeah. It's a great question. Let's start with how he actually picks stocks. Because it's more than just liking a company's products or...
Right, yeah, there's got to be more to it than that.
Yeah, it's not just gut feeling.
I mean, he's got those two key indicators we talked about, the ROIC and EV,
Right.
but how does he actually use those to make decisions?
Yeah. It's not exactly a secret,
Oh, yeah?
but it is systematic. He ranks companies based on these metrics. So first, you'd calculate the ROIC for, a whole bunch of stocks, rank them from highest to lowest. Then you do the same thing with EV/bit.
So you're making two separate lists.
You are, yeah.
One for each, kind of like a stock popularity contest.
I like that.
But based on hard numbers
Exactly.
instead of like hype.
Yeah.
Okay.
That's a great way to think about it. And here's where it gets interesting.
Okay.
You combine those two rankings to get a composite score for each company.
Okay.
So a company that scores high on both ROIC and EV/bit.
Yeah.
Well, that's a strong signal that it's both a good performer and potentially undervalued.
I'm starting to see how this works. So you're looking for the companies with the highest combined scores, the ones that are at the top of both lists. Like,
Yeah.
they're winning on two fronts.
Exactly. And from there, you would typically select, the top 30 stocks or so to build your portfolio. But of course, you wouldn't just stop there. Greenblatt emphasizes the importance of further research. You'd need to dig deeper into the financials of those companies, look at industry trends, see how they stack up against their competitors. It's not as simple as just plugging numbers into a formula and calling it a day.
Right.
There's still a lot of homework involved.
So there's no magic bullet.
No magic bullet, no.
There's no guaranteed path to riches.
No.
It takes work.
It does. It takes analysis, a willingness to learn, and the discipline to stick with your strategy, even when the market gets turbulent.
Makes sense. You can't just like throw darts at a list of stocks and expect to hit a bullseye every time.
Hmm.
You need a system, a plan, and the dedication to see it through.
That's a great way to put it. And this is where Greenblatt's own evolution as an investor becomes really insightful. Remember, he started with those super concentrated small cap bets.
Yeah, yeah.
But he didn't stay there forever. He adapted.
Right. He moved towards a more diversified portfolio as he started managing larger sums of money.
He did, yeah.
So even someone who made his name taking big risks recognized the importance of balancing those risks as things changed.
Exactly. And his more recent shift toward mega cap companies, those industry giants, it
Yeah.
shows a further evolution in his thinking.
Mhm.
But what's fascinating is that despite holding these, well-established companies, he keeps his overall exposure to equities relatively low. That suggests a certain level of caution, a recognition that, the market may not always go up.
It seems almost contradictory.
It does, a little bit, yeah.
He's buying these big, stable companies, but he's not going all in.
Right.
It's like he's saying, I like these companies, but I'm not sure about the bigger picture right now.
That's a very insightful observation. It speaks to his commitment to value investing,
Okay.
to not overpaying for assets, even if they seem like sure bets. He's constantly evaluating the market,
Yeah.
looking for opportunities, but also being aware of potential risks.
I've always struggled with the idea of timing the market, trying to predict those ups and downs. Just, it feels impossible.
Yeah, it's really hard.
But Greenblatt's approach,
Uh-huh.
focusing on the fundamentals of individual companies,
Yeah.
that feels much more manageable.
It is. It's more about it's one of the key takeaways here.
Okay.
You don't need to be a market wizard
Right.
to be a successful investor. You don't need to predict crashes or time the perfect moment to buy or sell. Instead, focus on understanding the businesses you're investing in, their strengths, their weaknesses, their long-term potential. It's much less about trying to decipher all the noise and chaos of the market and more about really getting to know the companies that you're putting your money into.
That feels much less overwhelming
It is.
than trying to decipher all the noise and the chaos of the market.
For sure.
But what about those of us who are just starting out? Does Greenblatt's approach have anything to offer small investors
Oh, yeah.
with limited capital?
Absolutely. His journey actually highlights the incredible potential of starting small. Remember, he built his initial success on a portfolio of just a handful of small cap stocks.
Right.
Now, that approach comes with higher risks, as we've discussed, but it also offers the possibility of, outsized returns.
So for someone with a small portfolio, taking calculated risks on companies with, high growth potential
Right.
could be a viable strategy.
It could, yeah. But it's crucial to do your research, understand the risks involved, and be prepared for some volatility.
Right.
Don't just jump in blindly because you heard, someone talking about a hot stock tip. Take the time to learn about the company, its industry, its management team. Knowledge is power, especially when you're starting out with smaller investments.
Absolutely. So that same principle applies to larger investors as well.
It does, yeah.
But for someone managing a bigger portfolio, the focus might shift a bit.
It might, yeah.
Instead of chasing those massive returns that can come with small cap stocks,
Right.
the priority might be on preserving capital
Right.
and generating consistent, even if less spectacular, growth.
It is, yeah. It's all about understanding your risk tolerance
Okay.
and aligning your investment strategy with your goals. For someone with a large portfolio, a 10% return might be a fantastic result.
Right.
While for someone starting out, that same 10% might feel, disappointing.
Right. Yeah.
It's all relative.
This is making me rethink my whole approach to investing.
Good.
It's not just about finding the next big winner. It's about understanding the fundamentals, managing risk, and adapting to the ever-changing market landscape.
You've hit the nail on the head. And that brings us back to that incredible statistic we discussed earlier.
Yeah.
The one that really stuck with me. Only 4% of stocks drive all market gains.
Yeah, that one's hard to forget. It makes you realize just how difficult it is to consistently pick winners.
It does, but it also highlights the importance of of not getting discouraged. Even if you don't hit a home run every time, a consistent, disciplined approach based on sound principles can lead to significant long-term gains. It's a marathon, not a sprint.
A marathon, not a
Mhm.
sprint. I like that.
Yeah.
And even if we don't find all of those, top performing stocks,
Right.
we can still build a successful portfolio
Yes.
by making, smart choices, managing risk, staying informed.
Exactly. It's about having the right mindset, the right tools, and the patience to see your plan through.
All this talk about the 4% has got me wondering,
Yeah.
what actually sets those top performers apart? What do they have in common?
That's a fantastic question, and one that deserves a deep dive of its
I'm
own.
so glad you said that,
Oh, yeah.
because that's exactly where I was hoping we'd go next. All right, so we're diving into the elite, that top 4% of stocks that drive all market gains. What sets them apart?
Yeah.
Can't just be luck.
Definitely not luck. Our research on Greenblatt points to a few recurring themes in the companies he's been betting on lately. It's interesting to see how he's applied his principles to find these potential
We'll
winners.
spill the beans.
Yeah.
What kind of patterns are we seeing?
Okay, yeah, yeah.
I'm ready to take notes.
So first, these companies tend to operate in industries with enormous growth potential. We're talking technology, e-commerce, renewable energy, artificial intelligence. These are sectors that are like disrupting the status quo and reshaping entire industries.
Makes sense. Got to ride the wave of innovation, right?
Yeah,
So Greenblatt's not afraid to embrace the future. He's looking for companies leading the charge.
exactly. Yeah. Second, these companies have something called economic moats.
Economic moats.
Yeah, think of it like a protective barrier around their business, like Apple's brand loyalty, Google's search dominance, Tesla's electric vehicle technology, Amazon's vast logistics network. These moats make it incredibly difficult for competitors to chip away at their market share.
It's like having a built-in defense system, making them much more resilient in the long run.
Exactly. Now, the third pattern is visionary leadership.
Mm.
Greenblatt seems to gravitate towards companies led by individuals who are not afraid to push boundaries and think outside the box. These are CEOs with a knack for anticipating the future and adapting to change.
So it's not just about the product or the service. It's
Right.
about the people at the helm, steering the ship.
It is.
A strong leader can make all the difference, especially in a fast-paced industry.
Absolutely. And the fourth pattern is adaptability. The companies Greenblatt is choosing are not stuck in their ways. They're constantly evolving, experimenting with new technologies, and finding ways to stay ahead of the curve.
So they're not just riding the wave, they're creating the wave.
Yes.
They're shaping the future of their industries.
Precisely. They're constantly scanning the horizon for new opportunities and challenges, and they're willing to make bold moves to stay ahead of the competition. And remember Greenblatt's own journey, how he adapted his portfolio over time?
Right?
This seems to be a quality he values highly.
Makes a lot of sense. So it's not just about finding companies in like hot industries.
Yeah.
It's about finding companies that are driving that growth
Yeah,
with strong moats, visionary leadership, and a knack for adaptation.
exactly. Now, even with all of this information, it's still crucial to do your own research.
Mm.
Don't just take our word for it. Dig into those financial statements, understand their business models, assess their competitive landscape, and try to project their long-term growth potential.
Right, because even companies with amazing products
Yeah.
and strong leadership
Yeah.
can face challenges. Understanding the details, the nuts and bolts of how a company operates is essential.
Absolutely. Every investment carries some level of risk, and the market is constantly in flux. But by learning to evaluate companies based on these key factors, the same things Greenblatt seems to be looking at, we
Wow.
can make more informed decisions.
So we're not trying to eliminate risk entirely. We're learning to understand it,
Right.
to assess it, and to make choices that align with our own risk tolerance. That feels much more empowering than just, hoping for the best.
That's the key. And don't forget the importance of diversification.
Right.
Even if you find a handful of companies that meet all of these criteria, it's still a smart move to spread your investments across different sectors and industries.
Don't put all your eggs in one basket.
I agree.
A valuable lesson, especially given how unpredictable the market can be.
Precisely. Diversification helps protect your portfolio from those, inevitable market swings. It's a way to manage risk and create a more stable foundation for your investments.
This has been eye-opening. We went from like Greenblatt's own investment journey, how he evolved and adapted over time
Right, yeah.
to the specific traits he seems to be focusing on now. And we learned that those same principles, understanding the fundamentals, managing risk, and being adaptable can apply to all investors, big or small.
It's been a fascinating deep dive.
It has.
And hopefully, our listener has gleaned some valuable insights to apply to their own investment journey.
Absolutely. I
Yeah.
know I have. I feel much, much better equipped to approach the market with a more strategic mindset.
Excellent.
Right.
Remember, investing is a continuous learning process.
Yeah.
The market is dynamic and complex, and there will always be, new challenges and opportunities to navigate.
That's both exciting and a little daunting, but having a framework, a set of principles to guide our decisions,
Right.
it makes the whole process much less intimidating.
Well said. And remember, if Greenblatt, a seasoned investor,
Yeah.
can adapt and evolve his approach, so can we.
That's a great takeaway. Be flexible, stay informed, and never stop learning.
Exactly. And with that, we'll wrap up this deep dive into the world of Joel Greenblatt and the secrets of those top performing stocks.
Thanks for joining us on this journey of discovery. We hope you found it insightful and thought-provoking.
We did too.
Until next time, happy investing.